If you're thinking about moving abroad, or maybe you've already started investing outside the US and you're looking into getting some international tax planning, this video is for you. A lot of people call me and they don't really know where they sit international tax planning realm of the world. I'll have some people that call me, they're employed and making $100,000 a year. They've read some things online. They're looking at ways to pay zero tax or want to set up a foreign trust, or they start getting really complicated. Or maybe there's other people that have their own businesses and have a lot of things going on from an asset perspective, but really don't know where to start with as far as planning goes. So I like to break down the way I approach international tax planning into different levels. So of course, this isn't to actually put people or companies into specific boxes, because there's going to be some overlap between all of these levels, of course. So everybody's not going to fall squarely in one or the other, but there is a general level that different people are in. And I think it's helpful for people to understand where they fit so that they're not overspending necessarily on consulting and advisory that's probably not going to be worth it or beneficial to them, and also not underspending. People that are taking very basic approaches to taxes and overlooking big tax savings that could be there if they looked into it. In this video, we're going to talk about those different levels and specifically in some examples of what type of scenario applies at each level. So the first level that I look at, and I kind of look at it in numbers, but the first one is, I like to call it the wanderer. This is the individual that is spending some short time outside the US, or maybe making their first investment outside the US. So a typical scenario would be a self-employed person or an employed person that has remote work capability with their employer, and they're spending a few months a year outside the US. Otherwise, it's somebody that's maybe making an investment in a foreign property or something like that, real estate, or maybe even a rental property outside the US. And it's their first time doing that. These type of people generally have been doing their own taxes for a while, or maybe they're working with a local accountant that probably doesn't have international tax experience. The first step with this type of level of individual is make sure you're not paying more taxes than you would have if you had stayed in the US or had not invested abroad. And most importantly, make sure you're doing the right compliance, that you're not subject to unnecessary tax penalties. The first thing that happens when you start investing and moving outside the US is you're probably going to start adding forms to your tax return. So once you start doing that, the IRS has a really unreasonable way of penalizing people for not filing these forms. One might be the FBAR or a Form 5471 for a foreign company. We just need to make sure that those forms get filed on time. Otherwise, you have $10,000 of penalties as a baseline for these international forms. So that's really step one. And then also get in touch with somebody locally in the local country. Every country has their own rules, just like the US has its own rules for, when you're subject to tax here. Our states have our own rules of when you're subject to tax in a certain state. With this type of wanderer type situation, you want to make sure you're not being subject to tax in these foreign countries and overcomplicating your situation for the sake of a few extra days in one place or another. The first step is to keep it simple and not get subject to penalties. All right, so that's level one. That's the wanderer type level that we're looking at. Level two, the next step is, if you're liking this video, you should really check out my newsletter, where I put out different tips and tricks, latest law changes that can really help you save money and save complexity if you're living or investing abroad. Just think how much you could save with the right tax advice. What I call a settler. So this is somebody that actually is moving abroad. If you're an individual, you're moving there to stay. It's not just staying there for a couple of months, working and coming back to the US, or it's a company that's setting up an actual foreign company outside the US. So it's kind of that next level. The objective in this settler phase is to save taxes, but still keep things simple, because there's always a cost benefit analysis. That's where people get stuck a lot of times, is they're trying to jump to the super complicated planning of setting up companies and trusts and things like that, when the cost and administration of that type of scenario is not worth the benefit that you're getting from a tax perspective. In the settler scenario, we're trying to save money and keep it simple. So that could be looking at things like foreign tax credits, making sure you're not paying taxes on the same income in both countries, and you're paying the right tax to the right place, but also the foreign earned income exclusion. So actually eliminating tax in the US on your earned income, so self-employment and wage income. And that involves tracking your days days. So I have a lot of people, for example, that there is a day count in a lot of cases with applying for this foreign earned income exclusion. It could be the difference between that 1 week trip back to the US or not that could save you 30 grand on your US tax return. So it's knowing that in advance to try and save on taxes and applying for the foreign earned income exclusion benefit. And then we also look at simple things like your structure in the US. So maybe you have your own business and it was an S corporation. We're going to look at, does that S corporation still make sense now that you've moved outside the US? Because there's the tax planning for an S corp when you're in the US is at odds with the tax planning for a foreign earned income exclusion. So we look at some basic structural changes. You know, there's totalization agreements between the US and foreign countries to avoid double taxation of self-employment, and in some cases even eliminate it altogether. Self-employment tax, I mean, so FICA and Medicare. And then again, we're actually looking at local tax help. So in this case, instead of just making sure we're not subject to tax in that foreign country, you're going to be living there, so you're going to be a tax resident. And so first of all, we look, is it a country that you have to pay income tax to? You know, if you're in the Cayman Islands, for example, there's no Cayman Island individual tax return you have to file. But if you move to the UK or Spain or somewhere that does have their own tax code, we need to get you hooked up with a local tax accountant to make sure you're following their rules. And then we're coordinating on the US side to make sure that everything's done correct. So again, with this settlor phase, this is kind of the next step. You've moved to this foreign country, you're settling there. We're actually looking at ways to save you on taxes and take advantage of some of the benefits you have of being outside the US, but not get overly complicated with it because the benefits just aren't there from a cost and administrative perspective. All right, so that's level 2. As we've kind of gone through these levels, right, we have the individual, the wanderer, somebody that's spending a little time in the foreign country, want to make sure they're doing everything correctly, not getting penalized. And then in the settlor phase, we're actually starting to look at some tax planning opportunities, but we're not going overboard with it because the cost benefit's just not there. And before we move into level 3, if this has been helpful for you, if this is hitting home somewhere, please like and subscribe to the channel. It helps us to be able to create more content like this and keep putting out good information. So this last level what I look at, I call it the investor level. At this stage, this is where you have somebody that has pretty significant earned income every year and cash flow needs, and maybe significant assets outside and inside the US. So now we start looking at bigger structuring changes that could be beneficial from a tax perspective. You know, now we start getting into that point where the complexity can be worth it. And that's where there's a blurred line, of course, with the investor level and the settlor level in my example, because, you know, what is that line where it starts getting worth it from a complication perspective? I don't have a specific number for that because it's going to be dependent on every person. And there's other things to look at other than just tax as well when you're coming up with an overall plan and structure. In this investor level, you're starting to look at setting up foreign companies specifically for tax planning opportunities. Maybe you make more money than you need from a cash flow standpoint every year. So we start looking at ways to defer your tax through investing it through a foreign company. Or maybe we look at foreign trust opportunities and you're looking at actual estate planning. So we can start putting things in foreign trust and look at how we want that trust to be characterized from a US perspective. All these things complicate the US tax return, and we have to look at the benefit that you're getting from a tax perspective on that to see if it's worth it. And when you start having foreign companies, maybe you already have a US company, and so we need to look at the transactions between those companies. That's where transfer pricing can come in, to start moving income from one jurisdiction to another and pricing it properly so that you're doing it correctly between the two jurisdictions, but also getting the best bang from a tax perspective. And kind of as a last resort, we can also start looking at expatriation options, especially for people like accidental Americans that are already set up, invested, you know, outside the US in their own country. Maybe it makes sense to renounce your US citizenship altogether. So in this investor level, we start really getting complicated, and I don't like to necessarily just talk through all this with people, although I do, but I like to model out scenarios. So, you know, if we set up a foreign company versus a foreign trust versus an S corp, give me some assumptions and we're going to model that out and figure out which one gives you the best tax benefit. And then you take that information and apply it to the non-tax factors. Do you actually want to live in the Bahamas? What does that look like for your family? We start to layer that all in together. You know, I just think it's important when people start on this road of international investing, moving abroad, to be realistic about where you are from a planning perspective, and don't make it too complicated. If you have a self-employment job and you're making a couple $100,000 a year, you don't have significant assets, don't overly complicate your life with foreign corporations, foreign trusts, 6 different advisors telling you different ways you can go, because the cost benefit's not going to be worth it. Move outside the US, don't get penalized unnecessarily properly with things. And as you move forward and start growing your business, growing assets, then you can start looking at different forms of investment vehicles and things to complicate things. But if any of this hits home for you, or you think you fall in one of these levels, or maybe you just have questions, drop a comment below or reach out to us at McGowanTax.com, where you can schedule a call with me personally and we can put together a customized solution for you. If you're enjoying this video, please take a minute to like and subscribe to our channel and leave a comment below.